Hello traders, and welcome back to another fundamental summary of the week. Today we're going to be talking about the RBA and their pause on interest rates. We're going to be talking about the Swissy and its lower than expected CPI data. Also some more news on the US dollar with NFP out during the week. And then we're going to briefly touch on the Federal Reserve as well. Starting off, taking a look at the Australian dollar, we had the RBA confirm their pause with interest rates.
Finally, mortgage holders can breathe a sigh of relief. After 10 straight hikes, the Reserve Bank has left interest rates on hold.
And if the data encourages it, they may bring the rates up more in the future. This obviously led to some downside on the Australian dollar because a pause in interest rates is almost seen as a bearish sign. It implies that the economy is contracting.
Studio, Chris, what's behind today's RBA decision?
Well, Pete, this is a clear sign that the Reserve Bank feels it's finally landing a blow in the war against inflation. As for why the central bank has picked now to pause its aggressive rate hikes, well, in its statement, it gives a few reasons. It says it understands the full effect of the substantial rate hikes is yet to be felt. It mentions the volatility due to the banking crisis in the US and Switzerland, and it says inflation has peaked. As for whether we'll see another next month, well, the board says further rate hikes may well be needed, Pete.
Chris?
The world of macroeconomics can be an intimidating place, and that is exactly why we started Conquer Macro, where we are helping traders to understand fundamental and macroeconomic drivers and make better informed trading decisions. When you join Conquer Macro, you are going to have daily reports every day pre-London session to prepare for the day, a recap of the whole week in preparation for the week to come every Sunday, with bank reports, explanations, and a full-on course that will be posted in several chapters every Thursday. In this course, we included in our Theory Thursdays, the course will teach you everything you need to know about fundamental drivers for your trading, where we will speak about economic cycles, inflation, interest rates, central banks, risk on and off, market sentiment, bonds, and all the other data points that are relevant to make better informed trading decisions based off fundamental and macroeconomic drivers. So if you're interested in learning more about the macroeconomic world of trading, you can click the link in our bio. The US dollar, terrible readings all week long except for a strong NFP.
The payrolls report, seconds away.
Have the number now, and the economists win. 236,000 is the total for the month of March.
The Dixie chart translated that perfectly. The dollar dropped a lot until the end of the week when we had retracements. At the moment, it is still trading highly from data. The goal right now is to create our puzzle with all the pieces we have from the economic calendar itself. Doing this will help us to understand where the Fed may go next, and this is the main driver for the dollar at the moment. Next week, we have every data point concerning inflation. If the numbers keep on coming in lower, then it will add more bearish pressure on the dollar, because market makers will think that the Fed won't need to bring up the interest rates anymore. If inflation is sticky, then we could see some bullish continuation. We are totally data dependent here. The Swissy was a very interesting one this week. The currency had some trouble getting back in shape since the Credit Suisse situation, but we discussed that the more time passed between that and now, the better would be for the Swiss itself, as the fear would decrease. The Swiss is a safe haven, meaning investors put their money there in risk-off environment. We started the week with a much lower than expected CPI, which is an inflation measurement, implying we won't need to see much more interest rate hikes in the future, which is usually seen as bearish. But what's very interesting here is that because higher interest rates are damaging the economy and private banks like Credit Suisse, the data point was seen as bullish for the Switzerland economy. It implies that the banking system will be protected by taking fewer damages, which is reassuring. Thanks to that, the Swiss returned to its place as a safe haven and have seen some significant downside on most Swissy pairs because of the growing demand. However, just like the Japanese yen next week, the Swissy should trade from the market sentiment and act as a good bet if more uncertainty hangs over the markets. If you enjoyed this Sunday summary on the macroeconomic drivers of the week, please leave a comment, like, and subscribe to the channel. If you're interested in learning more about the macroeconomics world, you can join Conquer Macro today by clicking the link in the description below.